Good morning, everyone, and thanks for joining us today. I'm Susanna McDermott, Director of Communications at the Interfaith Center on Corporate Responsibility. And on behalf of ICCR staff and members, we welcome you to this overview of our 2023 Proxy Resolutions and Voting Guide. ICCR's Proxy Guide is an annual compilation of shareholder resolutions filed or co-filed by ICCR members for a given proxy season. For those of you who may be meeting us for the first time, I want to take 1 minute to just briefly introduce ICCR. Celebrating our 51st year, ICCR is a coalition of over 300 institutional investors representing more than $4 trillion in assets under management, who use their leverage as shareholders to engage portfolio companies on their environmental, social, and governance performance. Our guiding principle is that corporations must account for the full impact of their businesses on the environment and society, and should consider the well-being of all their stakeholders, including their workers, investors, customers, and the communities where they operate, as integral to their long-term success. ICCR's membership comprises a wide spectrum of institutional investors: faith-based organizations, asset management firms, union pension funds, foundations, and other responsible investors. ICCR launched the Investor Alliance for Human Rights in 2018 to grow the network and build the capacity of investors engaging on business and human rights concerns. We want to acknowledge the significant contributions of our partners and allies, without whom our work would not be possible. To learn more about our work, we invite you to visit our website at iccr.org. Before I turn things over to my colleague, Julie Wokaty, just a few housekeeping reminders. You will be in listen-only mode throughout the webinar. After speaker remarks, we'll open it up for a Q&A, and our speakers will be on the line to answer your questions. There are close to 700 registrants for this event, so we are asking that you submit your questions through the question box you should have at the bottom of your screen. We encourage you to submit these questions as they come up during the course of the webinar, as opposed to waiting until the very end in order to get your questions in the queue. When typing in your question, please tell us 3 things: your name, organization, and which speaker the question is directed to, if it is directed to a specific speaker. Whatever we can't get to on the call today, we promise to follow up on afterwards via email. Our emails are on the screen right now, and you can reach out to Julie and I. Also want to remind everyone that this webinar is open to the public, and with us today are members of the press, and all remarks are on the record. Finally, this webinar is being recorded, and a link to the recording, along with a link to the proxy guide, will be sent to all registrants this afternoon. So let's get started. My colleague, Julie Wokaty, will begin by providing a high-level overview of this year's proxy book and highlight some key trends. Afterwards, we'll hear directly from ICCR members about key campaigns this year, and then we'll jump into the Q&A. So, Julie, without further ado, Julie Wokaty, ICCR's Deputy Director of Communications and the principal author of the Proxy Guide, will provide an overview of this year's guide. Take it away, Julie.
Thanks, Susanna. So, good morning, everyone. ICCR began publishing the Proxy Resolutions and Voting Guide in 1974, just a few years after our inception. The guide contains the full text of ICCR member-sponsored resolutions, both as lead and co-filer, for 2023 corporate proxies as of February 16th. If you are an investor, we invite you to consider these proposals as you vote your proxies. A link to download the guide will be sent to you following the webinar. So I will take us through the key trends. So to start, ICCR members filed 377 resolutions at 227 companies. And broadly speaking, where did investor interest coalesce this year? Here we see a breakdown of proposals by issue. Proposals addressing the climate crisis and racial justice and diversity led the way with 92 and 85 respectively. Proposals on worker rights and human rights were the 3rd largest group with 71. Next comes corporate governance with 55, followed by lobbying and political contributions with 39. Environmental health and food saw 19, and health equity 16. Motivated by the existential and systemic risk it represents for people and planet, proposals related to the climate crisis accounted for just under a quarter of all resolutions filed by our coalition, close to the same proportion we saw last year. The largest group of these, 28, call for companies to develop climate transition plans with GHG reduction goals. The second largest group called for Paris-aligned climate lobbying, and another subset called on banks to develop climate-forward lending policies to better align their practices with their public commitments to achieving net zero emissions. Paul Rissman will be speaking about these proposals in a bit. Also of note, 4 proposals received asks citing the need for a just transition to renewable energy. Also this year, there were 85 proposals relating to diversity, equity, and inclusion and racial justice. Of these, 25 called for racial equity audits at companies in diverse industries. Racial equity audit proposals received strong and, in 5 cases, majority support at 2022 AGMs. This year, our members filed a group of 71 resolutions on human and worker rights risks. 9 of these asked companies to implement paid sick leave policies as a standard employee benefit. The lack of federal paid sick leave policy emerged as a critical issue during the pandemic, particularly for exposed frontline workers. Later in our webinar, you'll hear more about one of these proposals from Marvin Owens. In addition, unionization is also seeing a national resurgence, and another group of proposals called on companies to respect workers' freedom of association and collective bargaining. Hyewon will be discussing these later in the webinar. Members of the ICCR and Investor Alliance for Human Rights have been engaging leading tech companies on a range of human and digital rights risks for several years. This year, ICCR and the Alliance members filed 26 proposals for the proxies of Alphabet, Amazon, and Meta. Taken together, the issues raised in these proposals speak to the power and influence tech companies wield over society and highlight how a lack of adequate oversight structures to mitigate potential harms raises risks for all stakeholders. We'll hear more about these proposals from Sarah Couturier-Tanoh. This year also sees a growing investor focus on the need to mitigate the risk of doing business in conflict-affected high-risk areas, which can present severe operational and human rights risks for all corporate stakeholders, including investors. Several resolutions this year cited forced labor risks in doing business in and sourcing from the Uyghur region. Another group of proposals expressed how the Russian invasion of Ukraine might make companies complicit in human rights violations, including a Texas Instruments resolution citing the use of components in its Russian weapon systems. Corporate political activities also remain under heightened scrutiny. Investors are calling out corporations for misalignment of their political contributions and public commitments, focusing specifically on those that have given financial support to members of Congress who voted against certifying the 2020 U.S. presidential election results, as well as those who oppose federal voting rights legislation. Still other proposals in this group cite company support of the State Financial Officers Foundation, an organization that works to prevent investor consideration of climate risk and other ESG factors. As mentioned earlier, investors are also pressing a group of companies on potential misalignment between their stated goals vis-a-vis the Paris Climate Agreement and their lobbying activities. As Congress continues to debate how to bring drug pricing under control, members engaging the pharmaceutical sector to promote equitable access to medicines filed a group of proposals this year at 9 pharma companies seeking a report on the links between their patent protection strategies and patient access to medicines. Lydia Kuykendal will share more about these engagements in a moment. Members of the ICCR coalition are known for their innovative strategies in shareholder engagement. Among their new asks this year are assessing allegations of biased operations in India, fair director elections, impact of asset transfers on disclosed GHG emissions, patents and access, privatization of polluting assets, report on driver health and safety, transition plan to address abuse of Uyghurs, and others. When shareholders file a resolution, companies may reach out to the filers for a dialogue to discuss key aspects of the proposal and find ways to address its requests. If an agreement between both parties is reached that satisfies the main request of the proposal, filers may choose to voluntarily withdraw it. A few of the successful agreements reached to date by our members include Apple, freedom of expression transparency, Apple again on transition plan to address abuse of Uyghurs, Deere on climate transition plan and GHG reduction goals, United Natural Foods civil rights audit, and UPS on Paris-aligned lobbying. It's still early in the season, but we will be reporting out on ongoing withdrawal negotiations on our website as they become available. 45 resolutions this year, or 12% of all those filed by members of our coalition, have been challenged by companies and are being adjudicated at the SEC. And this is in contrast to 82 proposals, or 19% that we saw at this time last year. To date, the proposals seeing the most challenge relate to climate change and racial justice and diversity, as well as health equity. Again, it's still early days, but we will keep you posted on the outcomes of these challenges and on our website in the days ahead. So with that, we are now going to move on to our guest speakers. Thank you.
Thank you, Julie. As many of you know, there's been a concerted attack over the last 6 months or so from groups attempting to discredit ESG investing. We invited our CEO, Josh Zinner, to talk a little bit more about how this is playing out. So Josh.
Thanks, Susanna, and welcome to everyone, and thanks so much to all of you for attending ICCR's Proxy webinar. Before we dive into the details of some really cutting-edge member initiatives, I wanted to take a moment to talk about the broader political context that we find ourselves in. A sign of our growing success, both as ICCR and as a movement, is that our opponents are forcefully pushing back. As more and more investors and companies recognize that management of ESG risks is critical to long-term sustainability, the right wing has mobilized an extensive backlash to ESG and quote, woke capitalism to hamper corporate progress on climate change, worker rights, and so many other important systemic issues. With a deep infusion of funds from the oil and gas industry, and with heavy leadership from industry-funded groups like the American Legislative Exchange Council, known as ALEC, and the State Financial Officers Foundation, red state officials have been introducing and passing legislation and policy guidance that penalizes investors and companies that attempt to consider and address climate change and other ESG risks. These policy efforts have been gathering significant momentum in the past 12 months, including with the passage of laws in Texas and other states prohibiting companies doing business with the state from, quote, boycotting fossil fuels, and in some cases, even firearms manufacturers. Red state attorneys general have been issuing opinions declaring that under state law, consideration of long-term and ESG factors in investing essentially amounts to a violation of fiduciary duty. And these same officials have been issuing subpoenas to banks, asset managers, proxy advisors, and even law firms that support the concept of investing with an ESG lens. ALEC has developed model legislation that is being introduced in red states and will put further pressure on investors and companies that consider climate and other ESG risks. In addition, right-wing money has flowed into organizations that are increasingly entering the corporate proxy process, introducing a spate of shareholder resolutions designed to impede corporate progress on this very same issues that our members are engaging on. At the federal level, the SEC is under increasing pressure from a hostile Congress regarding a climate risk disclosure rule, very broadly supported by the investor community, as well as on other key regulatory reforms. Red state attorneys general have sued to block the Department of Labor's ERISA rule, which simply allows ERISA plans to consider ESG factors in their investments. And the new Congress is readying a Congressional Review Act resolution to try to undo the DOL regulation. So you see all the pressure that's being put on the work that we do. The irony, of course, of these aggressive policy initiatives intended to curb ESG investing can't be lost on any of us. The proponents of these policies, proclaimed supporters of an unfettered free market, claim that ESG politicizes investment. But the clear reality is that they're the ones playing politics with taxpayer dollars and pension returns. These wrong-headed policies tie the hands of pension fund trustees to consider long-term and systemic risks, such as climate change, and put the future returns of beneficiaries at risk for the sake of feeding a culture war that only further divides our nation. Evidence of the deleterious financial impact of these anti-ESG policies are having and will have is emerging. And we're beginning to see the pendulum swing back as bankers associations and other businesses push back on the impediments being put on their own risk management strategies. Mobilization by institutional investors, working with civil society groups, labor, and other key stakeholders is desperately needed to counter the anti-ESG narrative and to ensure continued progress by investors and companies to curb climate change and advance a just transition to clean energy, to protect worker rights and human rights, to ensure health equity, to bring accountability to corporate political engagement, and on so many other critical systemic issues. ICCR is working with a group of allies, including investor organizations and civil society groups, to organize pushback in a number of areas. There's a lot of work to be done here. If you're not already involved, we welcome you to join us to support this effort. We appreciate working collaboratively with so many of you on this call today. And I also want to give a big thank you to our upcoming panelists and look forward to hearing about their initiatives. Back over to you, Susanna, and thanks.
Yeah, that's great. Thank you, Josh. So yes, we're going to hear directly from our investor members now about some of the key campaigns this proxy season. So let me introduce Hyewon Han, Director of Shareholder Advocacy at Trillium Asset Management, who's here to talk to us about a group of proposals supporting freedom of association. Go ahead, Hyewon.
Thanks, Susanna, and thank you everyone for joining us for this segment on freedom of association. I want to take a moment to acknowledge that we're in a significant moment in time. You may have noticed that companies like Amazon, Starbucks, and Apple that were once considered highly unlikely to have union representation now have workers who have won historic union election campaigns. After decades of decline, unions are experiencing this resurgence in the United States. But because of this previous decline, an entire generation of management teams may lack experience working with unions and facilitating good working relationships, which may translate to knee-jerk opposition or missteps. So some of this misbehavior, according to workers involved in union campaigns, looks like retaliation, intimidation, firings, and forced attendance meetings by the companies. And this raised concerns among some investors that companies may not be acting in line with their own human rights commitments. Many companies commit to agreements like the ILO Declaration on Fundamental Principles and Rights at Work, the UN Declaration of Human Rights, or the UN Global Compact, and they all explicitly reference the rights to freely associate and collectively bargain. And some companies dispute violations of these commitments, but investors lack assurance that that's actually the case, especially because certain companies already have certain legal rulings against them. And there's even evidence to consider an alternate approach in which employers adopt a more neutral stance to unions. For example, one study shows that the more members a union gains, the more productivity increases within the firm. So in response, investors have filed shareholder proposals on freedom of association at companies such as Amazon, Delta, Starbucks, Rivian, and Wells Fargo. And they're relatively similar. And one example is the proposal at Starbucks, where Trillium, along with the New York City Comptroller, Perk, and Share, have called on Starbucks to conduct an independent assessment of its adherence to its human rights commitments and to close the gap on any departures from such commitments. And Starbucks is opposing the proposal by asserting compliance with US labor laws. But this defense falls short for two reasons. 1, the NLRB has already issued administrative rulings that Starbucks has acted unlawfully. And the other issue is that we believe the international commitments Starbucks has made involve obligations that surpass what is considered compliance with US labor laws, which are known to be weaker than that of other countries. In other words, an independent assessment is necessary because Starbucks appears to not be able to meet a bare minimum standard, and it has made much stronger promises. To make the business case even clearer, controversies such as these may affect brand value and employee morale beyond the retail level. A national survey showed that almost 70% of Starbucks customers support workers' organizing campaigns and believe that workers need unions to bargain for better schedules, better wages, and better working conditions. Bloomberg also reported on an internal survey of Starbucks corporate employees that showed that confidence in the company's ethics and social impact had reached all-time lows in October 2022. Comments posted by employees during the meeting voiced concerns about the company's approach to unionization and how the company's image would be affected by it. And all of this underlines that this is an issue of concern beyond the investor population. Consumers and employees who have a stake in the company and the company's success are also noting how Starbucks is acting. Assessments like the ones we recommend can provide investors and companies with an independent, objective perspective on a company's approach to its human rights commitments and help inform a company how a company should chart a path to avoid future labor rights related controversies. So we ask investors to support proposals related to freedom of association during this proxy season. Thank you. Back to you, Susanna.
Terrific. Thanks, Hyewon. I will now invite Lydia Kuykendal, Director of Shareholder Advocacy at Mercy Investment Services, to discuss proposals at pharma companies seeking to understand the role of patents on the pricing and access of branded medicines. Go ahead, Lydia.
Hi, thanks, Susanna, and thank you to ICCR for having me. And let's dive right into the exciting world of patents and intellectual property. I'm going to frame our conversation today in the US context just for this conversation, but we are very aware that this is a global issue and it does impact patients worldwide. Having said that, drug costs in the United States have been a prime political and policy issue for decades. And one of the main reasons Americans have the most expensive, but very far from the best healthcare in the world. There are several factors that play into this, but the proposal we filed this year at 9 pharmaceutical companies is aimed at examining one of those factors, and that factor is patenting practices by the pharmaceutical industry. The patent and IP system is complicated and it is multifaceted. This issue, however, is not. It is fairly simple. And the issue we're talking about today specifically is something that has been termed patent thickets. And this is the practice of applying for and amassing dozens or more patents on a single product. Pharmaceutical companies are using loopholes in an underfunded and understaffed patent office to game the system by creating these thickets of 10, 20, 30, 50, 100 or more patents around one single product. The practical impact of this is to intimidate and in fact sue their potential competitors out of the market. Now that's a problem because we are, supposedly in a competition-based economy. So with no competition, the economic pressures to price correct do not exist, and manufacturers of these products can just run amok. And that's exactly what we've seen happening. And the results have been absolutely devastating to patients. US prices for branded drugs are nearly 3.5 times higher than prices in 32 OECD member countries. Nearly 1 in 3, nearly a third of Americans has opted to not fill a prescription, somehow ration their doses of that prescription, or just try an over-the-counter substitute just because of the cost. These are not iPhones that these companies are making. In many cases, access to these products decides who lives and who dies. So for these reasons, we are asking pharmaceutical companies to help us understand if and how you consider patient access to your products in your patenting strategies. So why should shareholders specifically care about this issue? Don't investors make a lot more money the longer a monopoly lasts? And the answer to that is maybe. We don't really know. It is pretty easy to argue if you took the enormous amount of money spent on legal proceedings around patent protections and reinvested that in R&D, maybe they could be discovering more truly innovative drugs and molecules to make patients' lives better every day. Additionally, the regulatory risks are closing in. Just last week, the US Senate Judiciary Committee reported out not one or two, but 5 bipartisan bills targeting exactly this, targeting pharmaceutical patents and pricing and the relationship between the two. The Biden administration has made this a priority. The FDA has spoken about it. The US Patent and Trade Office itself just last year opened up comments to a rulemaking on this exact topic. Change seems to be coming. And if companies don't act, they will be left relying on profits from a regulatory structure that no longer exists. Bottom line of this is true innovation should be and is rewarded. That original 20-year patent is not being touched. Gamesmanship should not be rewarded, not when the quote unquote game involves people's lives. All we're asking for is enhanced disclosure around the relationship pharma companies build between patents and access, information that is vital for investors, shareholders, and other groups to understand how these companies, if these companies, are managing the risks associated with this patenting strategy. And I think that's close to it for me. Thanks, everyone.
Great. Thank you so much, Lydia. I just want to remind folks to please submit their questions in the question feature at the bottom of your screen, and to do so, as these questions come up, so that you get your questions in the queue. And now I'd like to turn to Paul Rissman of the Sierra Club Foundation, who will discuss proposals filed at banks around their financing of the emissions driving the climate crisis. Paul?
Thank you, Susanna. Hi, everybody. So I don't think I have to tell you that climate change on its current trajectory is going to be catastrophic for society. It's also going to be really bad for investors because it's going to have a negative effect on the global economy. So for example, a study by Swiss Re found that global GDP will be up to 15% less than it would be otherwise by 2050 if climate change continues on its current trajectory. So investors don't not only have a societal interest in stopping climate change, they also have their own personal fiduciary interest in stopping climate change. And so if they can figure out a way to mitigate climate change as fiduciaries, they need to do it in order to preserve their portfolio performance. Climate change is mainly driven by the burning of fossil fuels. And in order to prevent catastrophic climate change, we need to have net zero emissions by 2050 in order to hold global temperatures 1.5 degrees Celsius above pre-industrial levels. And so what all of the authoritative bodies have decided is that we have enough reserves of fossil fuels that we already know about in order to satisfy all global demand for fossil energy, if it's actually true and we're lucky enough to get to net zero by 2050. And that means that any new development and exploration of fossil fuels is going to take us past that. And we won't be able to meet our net zero by 2050 goal if we do develop new fossil fuel fields, oil and gas fields, and new coal mines. And so what we really need to do is make sure that new fossil fuel sources do not get financed so that they don't come online and the developers don't fight tooth and nail for them to keep belching out carbon way past the deadline for which is safe for us. So how do we do that? Well, public fossil fuel companies, private fossil fuel companies, state-owned fossil fuel companies, they all need money or they can't operate. And that's why the banks are so critical in this. And actually, the largest US major banks have all signed on to the Net Zero Banking Alliance. So their CEOs have actually made commitments to hold, to make sure that they reach net zero by 2050. So that's great, except the banks continue to finance new fossil fuel exploration and development. So how are they going to continue to finance new fossil fuel exploration and development and at the same time meet their 2050 commitments? No one knows. And when you ask the banks how that's going to happen, they won't give you a straight answer. And so that's why we filed shareholder resolutions with the 6 major banks, both As You Sow, Trillium, and Sierra Club Foundation, in order to get them to disclose, not only to get them to disclose exactly what they're doing with their clients, whose new projects they're financing, to keep them from doing that, and also to please come up with a policy to phase out this kind of financing. It's a real risk for banks because, for example, the Office of the Comptroller of the Currency has taken notice and says that where banks engage in public communication of their climate-related strategies, boards of management need to ensure that public statements are consistent with their internal strategies and risk appetite statements. A recent Federal Reserve Board study said that while banks claim to be restricting financing to certain activities that are associated with high emissions, to date, quote, most of these financing restrictions appear symbolic. So I didn't say that, the Federal Reserve said that. The banks note in their the risk factor sections of their 10Ks that reputational damage and client attrition could result from not meeting their sustainability commitments as material risks. But while the banks say, trust us, greenwashing is rampant. Deutsche Bank got raided, Goldman Sachs Asset Management and Bank of New York Mellon Asset Management got fined. HSBC got their advertising yanked. Royal Bank of Canada is getting sued. Greenwashing is endemic in financial services. We have voluntary organizations that are supposed to be self-policing, like Glasgow Financial Alliance for Net Zero. They've been weakened. They've been weakened partly by the banks. The anti-boycott efforts in red states that Josh mentioned earlier threaten the resolve of the banks too. Meanwhile, emissions increase. And for example, JP Morgan's commitment to reduce its emissions intensity, their emissions intensity actually went up in 2022. So we have no reassurance that the banks are going to meet their net zero commitments, which is a material risk for banks. And if it's a material risk for banks, then it's a material risk for their investors. So ICCR members have filed 2 types of regulations, 2 resolutions rather. One requests a policy for a time-bound phase-out of finance for companies and projects expanding fossil fuel exploration and development. This proposal is a less prescriptive version of the one filed last year because the banks misconstrued the last year's proposal in 2 ways. One was they said, well, this proposal is going to make us fire all of our oil and gas clients immediately. And the other misconstrual was to say, well, we want to finance the net zero transition with our oil and gas clients, and this will prevent us from financing the oil and gas transition or the net zero transition. So the proposal, first of all, does no longer asks to stop fossil fuel financing, a policy to stop fossil fuel financing. It asks for a policy for a phase out of new fossil fuel financing. And the other change is that each proposal has a carve out for banks who want to finance the transitions of oil and gas companies that actually have a credible transition plan certified by a third party. The As You Sow proposal is new and asks for the specific measures and policies necessary to achieve the bank's targets, the reductions to be achieved, and timelines for implementation. And this counteracts the vague assurances that we've gotten from the banks that they have everything under control. The last time we got these vague assurances from the banks that they had everything under control in the face of a systemic risk was in 2008. And we all know what happened then. So we urge investors concerned with the material risks of major banks greenwashing and missing their commitments, investors concerned with the systemic effects of catastrophic climate change on their portfolio performance, and anyone concerned with the kind of world that we will bequeath to future generations to support these resolutions. Thank you very much.
Thank you, Paul. Okay, I'd like to invite Sarah Couturier-Tanoh, Associate Director, Corporate Engagement and Advocacy at Share, who will discuss this year's proposals at tech companies, calling out a range of human rights risks. And I also want to note that our work on human rights and tech is supported by the Investor Alliance for Human Rights. Go ahead, Sarah.
Thank you. The pace of technological development has accelerated at an extraordinary rate in the past decades, and we have entered an unprecedented era of technological transformation. And this is not only affecting our daily lives, but also our society, our democracy, and our fundamental human rights. Human rights advocates and tech experts have warned us long ago of the risks that certain technologies like machine learning, artificial intelligence, or automated decision-making systems would represent to humanity. In the past decade, we have witnessed how certain technologies could threaten human rights, including freedom of association, freedom of expression, actually freedom of association too, rights to privacy or political rights. A robust body of academic research indicates that the impact of technology on human rights are not just unintended consequences, but rather reflective of systemic problems. And the use of technology exacerbates existing historical injustices and persistent inequities. The rapid development of technology requires companies to reinforce their human rights due diligence processes and establish more robust system of accountability and transparency. And most companies are not there yet. In response to these concerns, we have seen an increase of human rights-related shareholder proposals at tech companies in the past few years, especially at companies like Meta Platforms, Apple, Amazon, Alphabet. Several proposals are pointing out the lack of transparency of algorithmic systems or insufficient governance structure to promote accountability and transparency for human rights issues. And some proposals specifically focus on the human rights due diligence processes. For example, Share and Common Spirit filed a shareholder proposal at Alphabet asking the company to conduct their human rights impact assessment of Google's targeted advertising policies and practices. Google advertising represents 80% of Alphabet's revenue in 2021 and reached more than $200 billion that year. In this specific instance, Google has initiated a major technology and strategy shift that poses a number of uncertainties on what the impact of a large-scale adoption would look like on human rights, especially on data privacy rights. Companies have a responsibility to uphold human rights. According to human rights experts, the foundation and governance architecture needed to approach the specific problems of human rights in technology can be found in the international human rights law framework, such as the UNGPs or the UN Declaration of Human Rights. While certain companies like Alphabet are building human rights dedicated teams and have started to take human rights due diligence steps, including risk assessment, these efforts remain largely insufficient to mitigate the human rights issues stemming from their products and services. These efforts are insufficient for several reasons. The first one is that human rights assessments are sometimes used as a one-time attempt to manage human rights risk and impact, while international human rights frameworks recommend that such human rights due diligence should be embedded at the earliest stages of development of a new major policy, product, or service, and it should be carried periodically. Secondly, too often, human rights considerations rest in the hands of dedicated teams internally, while they should be integrated in software engineering and elevated in the boardroom for greater oversight and accountability. And lastly, the lack of transparency of algorithmic systems prevents civil society organizations, governments, and the public in general to understand how their fundamental rights are impacted. Investors also have the responsibility to promote the respect of human rights in the companies that they invest in. Besides the risk generated by the accelerating development and implementation of new technology, warrants investors' vigilance. The adoption of certain technologies without adequate structures of accountability poses financial, reputational, and regulatory risk, which can ultimately impact shareholders' long-term value. And investors are in a unique position to promote fairness, transparency, and accountability in that space through their active ownership activities. And this season, we will see key proposals on the ballots that can have a significant impact on the future of human rights in the tech sector. Thank you.
Thanks so much, Sarah. And finally, we'll hear from Marvin Owens, Chief Engagement Officer at Impact Shares, who will discuss their proposal at Norfolk Southern, calling on them to adopt a paid sick leave policy as a standard benefit. Marvin, take it away.
Hey, good afternoon. Thanks to the ICCR team for organizing this conversation today. Impact Shares considers paid sick leave to represent an important human capital investment critical to investors, as well as a racial and gender equity concern. Filing a shareholder proposal at Norfolk Southern Railways requesting that the company adopt a paid sick leave policy as a standard benefit was the first step in leveraging our position as an ETF issuer representing leading social and environmental advocacy organizations. We did this with the expectation that we would create changes in company policy toward workers. So much like our general investment strategies, the Impact Shares approach to the paid sick leave policy with Norfolk Southern really has been informed by our advocacy partners, specifically the YWCA and the NAACP. America's freight railroads, which slashed 30% of their workforce over the past 6 years and now face significant worker retention issues, really brought our country to the brink of a national rail strike by refusing to provide paid sick leave and address other working conditions during 3 years of contract negotiations. The White House and Congress intervened, if you all remember, last fall in an effort to avoid a rail strike, which, given current weaknesses in the U.S. economy, could have cost the country as much as $2 billion per day. Railway workers help move nearly 40% of the country's freight, including critical commodities. Yet under the Railroad Unemployment Insurance Act, railroad employees are only entitled to sickness benefits after 7 days of illness. So many of these workers face an impossible choice when they are sick: to stay home and risk their jobs, or go to work and risk their health and the public's health. Meanwhile, railway companies have reportedly paid out $196 billion in stock buybacks and dividends to shareholders since 2010. So focusing on the short term at the expense of workers poses potential risks to the company and the economy. As shareholders, we are asking management to take their longer term view that safeguarding the health and safety of their workers will better position them for the future. Our unique strategy of working closely with not just investors and corporations, but also leading advocacy groups helps to contextualize the current engagement in the context of a longer history of advocacy on issues of racial and gender equity. Specifically, the NAACP and the YWCA have long track records in working on these issues like paid sick leave, and both organizations have very close relationships with unions. So, as a corporate response to our shareholder proposal attempted to use collective bargaining and the Railway Labor Act as an excuse for a no action request to the SEC, we were able to really gain greater insights through the labor relationships that exist within the NAACP and the YWCA. Highlighting this concern as a racial and gender equity concern ultimately strengthens the case for changes in corporate policy while adding even more value to ICR's current relationships with organized labor. And finally, as you all have heard about the most recent train derailment in East Palestine, Ohio, these issues around paid sick leave and worker support has come to a head again, and we are now engaged with Norfolk Southern on this issue as they go forward. Thank you again for the time.
Thank you so much, Marvin. Great. So we've now come to our Q&A. Again, a reminder, please submit your questions in the question at the bottom of your screen, the question feature at the bottom of your screen. That's where we're taking questions. Josh, I'm going to call on you. We have a question from Caroline Bowden. Any insights as to why fewer proposals have been challenged this proxy season?
Yeah, we think a primary reason for that has to do with SEC policy. Some folks, I think, probably remember well that under the prior administration, when Jay Clayton was the SEC chair, that the SEC issued a series of guidance that really expanded the grounds, the bases for companies to exclude proposals from the company proxy and the no action process. And in November of 2021, under the new administration, under Gary Gensler as SEC chair, the SEC issued a new guidance that really narrowed these exclusions, for example, on micromanagement, for example, for proposals that deal with matters of broad societal impact, making it more difficult or narrowing the grounds by which companies can exclude proposals. And then last proxy season would have been the first proxy season when those when that new guidance was in effect. And a big shout out here to Beth Young and Sanford Lewis and Con Hitchcock and others who are really sort of the legal minds behind so much of the work that we all do. Under those new guidelines, managed to defeat the great majority of the no action challenges by companies. And so I think what we're seeing this year is that more and more companies are declining to challenge, to issue no action challenges because they're recognizing that the bases for exclusion have narrowed, especially after kind of testing the waters last proxy season unsuccessfully. So we see that as a primary reason for fewer challenges this year.
Okay, Josh, hang there for 1 second. Give us a brief, if you will, answer to this next question, because we've got a lot of questions and I want to make sure we get to as many as we can. This is from Tim Brennan. Regarding the anti-ESG movement, many of these laws, particularly at the state level, are being driven by ALEC, as Josh says. That organization receives funding from many companies with whom ICCR members have relationships. These same companies issue sustainability reports and say they are addressing climate change and DEI. Can ICCR members organize to engage these companies directly on their hypocrisy and maybe go public if they do not respond?
Yeah, the short answer is definitely, and we're absolutely looking at this. And Tim Smith is taking the lead at ICCR. So if you're interested in participating in this work, please contact Tim. I would say also that John Keenan, another longtime ICCR member, has been working for years with investors, talking to companies about ALEC membership. So John has done great work here, and other members such as You Sow have taken a lead here as well. So this work is going on, but absolutely something that we see as a priority. So please contact Tim to get involved.
Thanks. This is a question from Chris Gillum, and I can take part of it and then I can pitch it over to Sarah. Is there any action being taken on expecting AI to meet the specifications of responsible, trustworthy, ethical AI? Chris, just this morning, the Investor Alliance for Human Rights issued a press release regarding an investor statement. It was signed by 149 investors representing, I think, 1.6 trillion. It was sent to the agencies in the European Union that are in the process right now of negotiating regulation that's called the AI Act. So I can get that press release with the link to the letter to you if there's interest there. Sarah, anything further to add on that, on ethical AI?
Yes, generally, I know that there's like the European Union and other countries, other legislatures that are starting to think about how regulations and policies can safeguard human rights when AI systems are implemented. And on the company side, just like I said, now most big tech companies have taken human rights due diligence steps, but they're far from being sufficient. And governments and private companies have been starting using AI quite rapidly and without carrying appropriate due diligence to identify the human rights impact of the technology. And it is also a fairly new technology, and we don't know yet the extent of the damages it can cause. But what we know now, based on the research, but also based on real life examples, is that there are many human rights risks associated with the deployment of this kind of systems, such as racial, gender, or religious discriminations, rights to health, freedom of movement, freedom of association, freedom of expression, etc. And advocacy groups and international human rights organizations have called for a moratorium on the sale and the use of AI systems that pose a serious risk to human rights until adequate safeguards are implemented.
Great, thanks so much, Sarah. We have a question for Lydia from our ex-board chair, Francis Sherman. Good to see you, Frank. Patent thickets and extensions are supported by our patent laws. What's the business case for an individual company to not extend their monopoly? Given that companies have incentives to extend their monopolies, should we be focusing our energy on regulatory changes?
Hi, thanks, Frank. So I'm going to wordsmith you a little bit, and I'm going to say patent thickets and extensions are allowed by our patent laws, not necessarily supported by. If you talk to pretty much anyone that doesn't work for the pharmaceutical industry, they'll tell you this is not the way the system was designed to work. It's not illegal. To your point, absolutely, what they are doing is legal. Now, I think there's a very good argument to be made that just because something is legal does not mean you should do it. But from a purely business case perspective, I alluded to it a little bit earlier in my remarks when I said, look, the companies are spending enormous amounts of resources building these patent thickets around a single product. And that extends their exclusivity or their monopoly for a few years, sometimes 5, sometimes 10, which for patients is incredibly impactful in their inability to access a product. However, if companies took all of those resources and reinvested it in their R&D pipeline, then they find a molecule, a drug, and they get 20 years of exclusivity and monopoly on that product. So it seems that that would be slightly more effective and efficient for these companies. And so not only are you legitimately helping patients and changing their lives, but you're getting, honestly, just a longer period of exclusivity on a truly innovative product, if that's helpful.
Thank you. That's helpful. I have a question for Paul Rissman from Emiliano Torraca. He's at UBS Asset Management. Last year, similar proposals received limited support. What has changed in your approach since then, which would help these proposals to get more support? How have these proposals changed since 2022?
Yeah, so as I mentioned in my presentation, they've changed in 2 major ways. The last year's proposal called for a policy to end fossil fuel financing for new fossil fuel exploration and development. And this year's proposal asks for merely a policy on a phase out, a time-bound phase out. So the banks all know that they're going to end financing for new fossil fuel exploration and production at some point. They're not going to do it, finance it to kingdom come, but they won't make a policy about it because they don't want to be held down to their commitment. All these banks made commitments. They got to be held to their commitments. The CEOs signed all the pledges. The SEC is watching. The regulators are watching. The ECB is watching. Everybody's watching. So the banks know that they're going to eventually do this. We would like them to have a time-bound phase out as part of their policies. The other change is that we now provide a carve out for banks that can continue to finance new oil and gas exploration and development for companies that have been certified by a third party, a credible third party, that they are on a credible net zero transition pathway. Now, no oil and gas company has been certified in that respect in short, medium, and long term. But that doesn't mean that they won't be at some point. And so if there is an oil and gas company that actually is certified by, for example, Transition Pathways Initiative or Science-Based Targets Initiative, if once Science-Based Targets Initiative comes out with an oil and gas sector template, then banks can continue to work with those clients. So these resolutions are less prescriptive than they were for the 2022 AGM season. We have met with some large investors who have confirmed that they think that they are less prescriptive and are therefore more attractive for supporting. And so we will see how the support goes. I would also note that a lot of investors withheld support for the resolutions last year because they were worried about the dislocations in the oil markets as a result of the Ukraine invasion. And now we have, the price of gasoline is at pre-invasion levels. Europe seems to have done pretty well in weathering this storm. And so I don't think there's going to be the same amount of trepidation as well on the part of investors who are worried about the Ukraine invasion.
Thank you, Paul. Marvin, I see you're answering. There are several questions for you. It looks like you're answering them in the chat. So I'm just going to leave you to that. Here's another one for you, Josh. Given the red state pushback to ESG investing, what are best strategies to counter this, quote, political campaign against responsible investing?
Yeah, I mean, there's a lot of strategies that are important here. A key one is really countering the messaging that's coming out. This sort of this strong blast of messaging about how this is about woke capitalism and hijacking pension returns, when it's really just the opposite. That ESG is really about smart investment strategies, risk management, and the fulfillment of fiduciary obligations, especially for beneficiaries who are getting their returns in 15, 20 years. So it's really important to turn that messaging around. And I think we're seeing that coming through in a powerful way from state treasurers who are more responsible and cognizant of these long-term risks, certainly in blue state treasurers in particular. We're seeing, as I mentioned in my remarks, bankers associations and banks really starting to push back because this is really about risk management, and they don't like being told how they should manage risk. And so I think as we're seeing, again, the more responsible elements of the business community pushing back on these initiatives, I think, we're going to see the tide turn. So really changing that narrative is really, really an important piece of that. And, feel free to reach out to me directly, anyone that kind of wants to delve into this further, because we've been doing a lot of work in this area.
Thanks, Josh. I'm going to try for one, potentially two more questions if we can get to it. So let's keep the answers as short as we can, understanding, folks, that what we don't get to, we can follow up via email. This is for Marvin from Bessie Yang. Canada just had a new law on paid sick leave, and all the railroad companies have allocated funds to compensate the workers. How do you think we can make an impact beyond the railroad companies? And there's a follow-up. Given U.S. does not have any federal level law or protection for workers on sick day benefits, are there any more movement or works going on in this space?
I think what we're seeing is actually CSX is now negotiating a paid sick leave policy with a few of its unions, and so I think that's an important trend that we're continuing to watch. I think generally how I would answer this question is kind of understanding how things usually work. Often public policy is directly impacted by the actions of the private sector. And so as the private sector begins to struggle with paid sick leave as a policy and kind of moving in that direction, I think that will really have an impact on the broader public policy conversations, even on federal legislation. So I think this is an important movement. If we can move these private sector companies in this direction, I think it'll have a direct impact on the larger federal policy conversations.
Terrific. I see that the chat was disabled for the purposes of this webinar. And so Marvin, some of the answers that you provided in the chat didn't get to the people. So I will provide those questions to you and their emails and hope that you can respond via email to some of those questions. I think we're at the bottom of the hour, folks. So I'm going to close it off. I just want to thank again all of our terrific speakers today. Thanks for extending yourselves to ICCR, and thanks to the audience for some of the great questions that came in. And if there's anything left unaddressed, as I said, we'll make sure that we get to it. The link to download the proxy book will be mailed a little bit later today, and we encourage you to please share it broadly with your constituents and networks. The recording will also be shared, and we can make a PowerPoint of this deck and share that as well today. We also just want to underscore, as we always do at the end of these webinars, the importance of remaining active owners of our stocks and exercising our rights as shareholders by voting our proxies. Okay, that's it for us today, and thank you, everyone. Have a wonderful day.